you can look at yourself and know that you act on emotions, and the fact that real estate prevents you from acting. And that, from somebody like myself who comes and knows all financial behaviors and preach the right behaviors for other people, we're human.
Yeah.
It's inherently in our DNA to run from investments, which is what happened in the stock market yesterday, right? You had all of these sellers, primarily retail folks, the Reddit folks who were, I can't take anymore. They said, uncle, they sold. And the nice thing is all these institutions who are sitting on records amounts of cash came in and said, we'll buy that. This is a great discount. Thank you very much. And you had a feeding frenzy from the institution. So I thought that point about protecting yourself from not being able to sell at the wrong time. Yeah, I think we're human. It's what we're going to want to do.
Yeah. It's, speed, money, emotions, mistakes, all these things we eat ourselves. One of the other things I'll say about this is if your portfolio is keeping you up at night, that's a sign.
Yeah.
And how many of you are staying up at night because of this or that? And if you're in crypto and you're trading on margin, I just want to say right now, you're an idiot because you're going to get washed out. They're going to eat your lunch.
Yeah.
Yeah. You could have an expletive in front of that idiot as well. And that works for me. That's a technical term, only discussed. You'll find that in the CFA handbook. So, one thing I did want to add to that is leverage, because, real estate is highly levered. And, when you look at most, single family homes, for those folks that are building out those, rental properties one by one, you're levered. And most folks are probably, 75 LTV is probably a normal, maybe a little bit more, less, just depending on everyone's individual situation. But one of the things there is in rising market that we're in today, it works out really well. But when things go the other way, and eventually they will, real estate is an inelastic product, and eventually supply will meet the demand. It'll pass by, and just in a blink of an eye, it'll go the other direction. And things could get really ugly when you're levered. And, it is something that I think is another disadvantage that we didn't really mention, but we went there, and it could really hurt your overall portfolio.
Well, let's talk about that, because yes and no. Mathematically speaking, sure, but it also depends on your debt. So we have to piece this apart. So let's first talk about residential. So 4 units and below. Inside residential loans, assuming you do what I talk about, which is 30-year fixed rate debt, it does not matter what the asset is worth once the loan is done, as long as you make payments. There were plenty of residential properties that fell by 50% that were not foreclosed on because the owner was making the payment, right? They got to live somewhere. Residential debt, 30-year fixed rate mortgage wipes away that concern. Assuming you're getting positive cash flow, you're not betting on negative cash flow or appreciation. Assuming you're doing what I teach, you're going to be just fine. It doesn't matter. Now, why did Mike Zuber spend a year or 9 months refining every apartment into 30-year fixed rate debt? Because commercial lending is different. And this is why I think commercial lending is about to blow up. Office, retail, and yes, even multifamily. Because inside the commercial loans, first off, 25-year AM versus 30, which does affect payment. But usually there's 3, 5, or 7-year terms where you are forced to refinance. And if you refi into an environment with higher interest rates and flat or negative rents, your value calculation is going to be all wonky. And you may have to cut a check. And heaven forbid you're in an LP, in a GP, in a bigger property, they could come to you and do a capital raise. I am not touching any of that junk, because there are stupid deals being done today.
Yeah.
I'm like, what are you guys doing?
Zuber, by the way, so an analyst that if you're into real estate, you should be watching is Ivy Zellman. She's been hitting some taglines recently that are more the pop culture sort of research. If you look at her real research, her biggest scare right now is in the multifamily syndications.
Yeah, it should be. It's crazy.
100%. To your point, their pro formas, they acquire the property, at a 8% cap. They go to sell at a 5% cap. Not a huge spread, right? And their debt structure was probably based on a 4, maybe 5% rate. Well, that's going to go to 6, 6.5, maybe 7% now, right? So that spread probably collapses. Very risky. Two, a lot of these loans, again, single family, non-recourse. They can't, if as long as you're paying the payments, they will come after you. And commercial, they will come after you. Recourse is a real thing. Now it's becoming less and less as I'm seeing in my deals. You can have these bad boy carve outs, as they call it. But in general, recourse loans are still a thing in commercial. And to your point, they will come after you to liquidate the asset if they need to.
Well, again,
by the way, where are you finding multifamily at an 8% cap?
Yeah.
Can you
exactly.
get on that ASAP? Because we just had Craig Berger on here from Avid Real Estate on the last episode, and he just purchased a property in Houston in the 3s. Yeah. But I was actually surprised because one of the ways that I do my underwriting and analysis of a deal, it was well below market value. So although the cap rate wasn't attractive, the undervalued rents I thought were extremely attractive. So yeah, not all deals, even though are expensive or fair market, there can still be meat on the bone there as long as those pro formas are done right. But yeah, I think, just depending on the property, I think Class A is probably tough. Just like you mentioned, Class C is probably you've got more of a spread and more of an opportunity for upside. Now, you do have some risk involved just because of the nature of the tenant. So, but you look at the nature of the tenant, they tend to be workforce housing, but then you look at where we are with how tight we are in the employment markets and the fact that those folks are probably going to have a gig and they're probably going to start making some more money.
Well, so these are all things we have to watch out. So again, if you're getting 8 caps today, go nuts. I've actually seen deals in the under 4 because I'm an accredited investor. By the way,
totally for example.
Yeah, I know.
I haven't seen it either.
Let's pick on Tom.
Yeah,
I haven't seen it either.
You're that guy today. We're picking on you. But I've seen some very dangerous things. There are some deals that I've out there that I actually think we're going to go into a recession and unemployment's going to turn around. So the fact that we're at 3.9 today, participation rate, all that. So I don't know that end of this year or next year is very good. I think we have a recession, but that's a different story. If your GP is buying something sub 4 and telling you the exit is to get the cap rate to 2.5, run away from that deal.
Yep.
Run away.
Totally.
And there are people doing that. I have seen presentations where they're going to take an asset at 4 and their plan is to get the cap rate down to 3. Folks, in a rising environment, the risk adjusted return of 3 is you get a 10-year pretty soon at 3.
And this is why Ivy Zellman, famously known for her call, the '08 crash, is so scared of that market. It's just too tight right now, way too much risk.
Too much money.
Which is why if you're going that route, development just seems like a safer bet there. And although you may not see a preferred rate of return or clipping some sort of a yield, it is probably safer because the cost to build versus the relative cap price, you're probably going to get a few points of delta there. So
thanks, Mitch, but I'll tell you, supply chain's still a headache.
Yeah, well, hey, supply chain and permitting, it's never fun. Yeah. Guys, this has been enlightening for our listeners. I hope that you go out and listen to Zuber one deal at a time.
Rental at a time.
Sorry.
It's all right.